David Nelson is with us, Chief Strategist at Bell Point Asset Management. David, I looked at your notes and it seems like you are ready to prepare for higher yields and that this is a move that could be sustainable. So how do you structure a portfolio around that?
Look, we're hostage to the yield, to the 10-year yield. It's the first thing we look at in the morning, and it's probably the last thing we look at before the market close. You know, at 1.6%, it's less the absolute yield and more about the velocity of the move because it implies higher yields coming forward. And, you know, relative to a 4.5% earnings yield from the S&P 500 on its own, it's not that challenging. But if yields move higher, at some point in time, it becomes an investable asset class and it's going to suck money out of the market. It's certainly affecting what's going on underneath the surface. As yields move higher, we start to move out of long duration equity, and that points to technology.
So, okay, say that to me again, David, real slow. Are you saying that this is going to be eventually a NASDAQ and a tech move that can break away from rates? Or do you want to just kind of have a foot in both sides and go whichever way ultimately wins out?
That's a good point, because we are in the lifeboat, and day to day we rush from one side of the lifeboat to the other. I'm trying to situate myself right in the middle. I'm certainly on both sides of the growth value debate. I have large, what I would call overweights to areas like financials, industrials, the commodity complex. That speaks to the stimulus trade. But I've got enough growth in the portfolio to survive on days like yesterday and earlier in the week. But it is a challenge. And at some point in time, you know, each stair step higher, it challenges the bull thesis for stocks.
All right, David, where do you go then to get the most kind of, you know, alpha from each side? Or maybe, I guess, if you've got a little on both sides, you just want to go whichever one wins the most. And maybe it's beta, I'm not really sure. But how do you get extra on top of what the market's doing if you kind of want to stay in the middle? Isn't there like a scripture about spitting out of the mouth if you're in the middle or something?
Okay, so let's dig down into it. So you can look at the areas like financials, industrials, and commodity complex. The commodity complex is interesting because it's only 2% of the S&P 500. So if you overweight it at, say, 5, 6, or 7%, you're adding a lot of alpha to the portfolio. Right now, everybody, for the last decade, the only place to be has been technology. But as we've got 6% potentially, possibly 7% GDP, other parts of the economy have woken up. And it makes a lot of sense to move down the valuation curve into some of these obvious winners. The steepness of the yield curve screams financials. It's the lifeblood of every bank out there. I don't care which one you buy. Take your pick. It's a good trade right now. Okay. Now, the commodity side, I think this is interesting, right? Because this is something that seems to be making some pretty big technical moves. We've been spending some time looking at the crude chart here, trying to break out of like multi-year downtrends. When you say commodities, a lot of people think crude. Is this? Do you look at it as a basket of commodities? What's the best way to get exposure to that type of trade? On the commodity side, I own a lot of the individual stocks. On the crude side, I just had nothing I could go in and focus on. So I was really simple when I made the trade, and I went into just the XLE because it was the only way I could play it, because a lot of those companies were cash flow negative at the time I was looking at the complex. When they screamed higher that first day, that 15% move, that was a wake-up call. And even if you got in on that day or the following day, you've obviously made a lot of money since then. Okay. Do you, David, have a strong view on what we should expect from Powell next week? Might as well start collecting as many opinions as we can after he kind of put markets into a little bit of a tailspin last time he spoke. Jay is going to probably draw bonus as much as he can, and he's going to tell us that they're as dovish as they can be. And if you look at the policy rate charts right now, 90% of economists see nothing happening until 2022. And you can bet every word is going to be parsed looking for some hint. But at some point in time, they're going to have to defend the other side of the dual mandate, and that's inflation. And maybe the basket isn't showing inflation right now, but everything I'm buying out here in Greenwich, Connecticut is going up. Okay. Well, I heard the houses are going up there, too, so that might have something to do with it. David, when we do finally get these numbers, everybody's been talking about inflation. What do they need to actually be? I'm looking at the estimates for CPI next month, and they still have a 2 handle on most of the estimates I see. Is this market pricing in something bigger, hotter, and scarier than what is currently on the books? Gosh, I don't know. There's a couple of ways to play it. Obviously, equities are a place that you have to be, but it's going to demand that we have higher and higher growth to support some of the valuations that we have. In the bond market, you could look at some things out there like Nancy Davis has a great ETF out there, iVol, that makes bets on the interest rate on the yield curve. So you're owning tips and you're betting that the yield curve is going to steepen. That's a good place to be for, say, a bond investor.
Okay. David, thanks for the thoughts. Nice convo here. Let's close out the session. Thanks a lot.
Thank you.
David Nelson, the Chief Strategist at Bell Point Asset Management.